Welcome back to the #1 semiconductor podcast in the world. Today, we're going to take a closer look at Intel Corporation. Yes, your favorite semiconductor company. Well, unfortunately, the company did report earnings and the stock is down roughly 12% as I am recording today's episode. And on today's episode, what I really want to do is take a closer look to see, is this an overreaction to the earnings call? Was it really that bad that we needed a 12% decline here on the stock? Well, let's take a closer look.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so first, let's just pretty much start off with their Q4 overview. Q4 revenue was $15.4 billion. It did see a nice 9% sequential increase and a 10% year-over-year increase. So this is pretty good, as in the past few quarters, in the past years or so, we've kind of seen a real weakness in Intel in forms of revenue due to numerous things, right? The overall competition from companies like AMD taking market share in the client and the data center market. And unfortunately, Intel has also been hit with the huge over inventory correction impacting the overall semiconductor that has really caused revenue to kind of see a bit of a slowdown. But we can see earnings per share did kind of beat their overall guidance, and revenue and earnings per share actually also did beat analyst expectations. So we did have a very, very strong Q4. Now, the company did report $4.6 billion in cash flow from operations for this quarter, but unfortunately, this company is using a lot of money for its capital expenditure, or CapEx, which was roughly $5.9 billion this quarter alone. And one of the main reasons is this company is really pushing into that manufacturing endeavor. So we're going to see some of the updates there, but that unfortunately led to adjusted free cash flow of roughly a loss of $1.3 billion. So now if we take a closer look at segment-specific performance, their client computing, and this is, hey, the chips that go into your laptops, into your desktop, that actually saw a 12% sequential increase. And because we are getting better inventory, we're kind of leaving that inventory correction and inventories are normalizing, that was up 33%. So that's great, right? We're seeing this, and that bodes well for a lot of other semiconductor companies. And if you guys know me, most likely tomorrow I will be releasing a video on how Intel's earnings might implicate something for AMD and NVIDIA, so make sure to stay tuned. Their data center market did see a 4% sequential rise to $4 billion. Unfortunately, is still seeing a 10% decline year over year, most likely from the competitive pressure from AMD, but also the shift in wallet spending. A lot of the spending is kind of going into GPUs right now. Main reason NVIDIA is pretty much killing it. What I thought was pretty interesting was their IFS revenue was $291 million, but was up on a 63% year over year basis. Now, the reason the stock price really saw this nice 12% decline is guidance, and this guidance is not what many were expecting. The company reported revenue to be somewhere around $12.7 billion, and that would be up a nice percent, almost 8% on a year over year basis. But unfortunately, analysts were expecting closer to $14 billion. So a huge disconnect between guidance expectations and what the company provided for Q1. The company did mention that, hey, look, there are two main reasons for this weaker guidance. First, they do mention that while their core business, including client servers, edge, and products, are doing well in Q4, they are tracking to the lower end of seasonal for Q1, and that's definitely some negative news to some extent. It could kind of showcase that, hey, look, there's too much competitive pressure in all these markets right now. Outside of that, they are seeing a lot of headwinds in their non-core products. For example, their automotive and their PSGs, which is the programmable solution group, which things like FPGA and other businesses that are kind of they're exiting out of, are really kind of impacting overall revenue growth in Q1. And this is not new news. If you have been following the semiconductor market, we do know that the automotive market, the FPGA market, and the programmable solution group market has been in quite of a slowdown right now. We are expecting that to continue at least in the first half of 2024. Now, they do mention that they expect Q1 data center revenue to decline double-digit percentage sequentially before before improving throughout the year. And investors might be a little bit shocked by this, right? Because Intel just released their Generation 5 CPU, so they would have thought that, hey, maybe we might even grow sequentially as well. But a double-digit drop here is another reason to be a little bit worried about this. But remember, as we're going to see, Intel does have a nice pipeline of products coming in. They do mention that in consumption of PC shipments, it was roughly 270 million in 2023, and they do expect the PC total addressable market to be up low single digits in 2024, which bodes well for the company's overall earnings and obviously their client segment. Now, while they see the kind of the pain in quarter one to be temporary, they do expect sequential and year-on-year growth in revenue and earnings per share for each quarter of fiscal year of 2024. So I'm really liking that they said that, hey, look, it's going to be short-term lived, and we're going to see those sequential growth coming up. So next, I want to take a closer look at some other things. But first, I do want to say thank you guys for the support. We just hit 30,500 subs. This is the best place you're going to find any semiconductor news. So make sure to hit the thumbs up and the subscribe button. I really do appreciate it. If you want to support the channel a little bit more, check out my special offer at fool.com/Jose. Now, when we talk about Intel, I do believe an important aspect now is manufacturing. Even though IFS is sitting at what 220 something $200 million at the moment, it's a very small portion of the pie. The main reason is this company isn't really going to have external customer revenue until 18A comes out, and that's still about a year or in some change away. But the company did mention that, hey, look, lifetime deal value for IFS is now over $10 billion, which more than doubled from their last update, and that's pretty great. The main reason is they do have advanced packaging wins. Intel captured 5 design wins for advanced packaging in 2023, with the majority of revenue expected to start in 2025, and then they have 4 customers for 18A, a lot of them dealing with high performance computing, and a lot of them doing a lot of prepayments. So obviously this bodes well for their manufacturing endeavors. Continuing here, they're really pretty much doing really well. They got their first high NA EUV machine from ASML. They even beat TSMC to get this tool, and that obviously bodes well, as this is going to help them build chips in their 18A Armstrong era, which is 2 nanometers and below. So that's pretty interesting. And they're also one of the first high volume manufacturers of logic devices using EUV in both United States and Europe. So they're kind of showcasing, hey, look, we are definitely a great replacement to TSMC, as we do have foundries all over the place. Just to kind of bring back people to reality, though, we do see TSMC also expanding into those regions as well. The final thing I think I want to cover is the AI and data center market. And I do believe this is where investors were probably hoping for a little bit more growth. They do mention that, look, in quarter four, their server business experienced solid sequential growth consistent with market share, which they believe was flat with quarter three. So they're saying, hey, look, quarter three, we haven't really lost market share, and they do believe momentum is building for positioning them back to win market share from AMD. So those are interesting thoughts that actually might be bullish, but right now that's not the case. They do mention that Gaudi 3, which is their AI accelerator, is on track to launch this year, and they mentioned the accelerated pipeline for 2024 grew double digits sequentially and is now well above 2 billion and growing. And they recently increased their supply for Gaudi 2 and Gaudi 3 to support the growing customer demand and expect meaningful revenue acceleration throughout the year. And I think this is where investors got a little bit worried about Intel, right? Right now, a lot of the money for AI, for the semiconductor market, is actually coming from AI solutions. And Intel, AMD has the MI300, and they said really closely that, hey, look, for 2024, we're going to have at least $2 billion. Intel, their wording is a little bit different. They say they have a pipeline above $2 billion, but they never say when they're going to get that revenue. So it's really kind of hard to understand how Intel is really doing with their Gaudi 2. Even though Gaudi 2 is an amazing AI accelerator, we have to really start to see it. Intel, this is definitely a growing opportunity for them, but it does seem like with capacity and supply chain constraint issues, they're not going to able to kind of grow this to full extent. And maybe this is what investors were looking for: AI chips. It does seem like right now AI chips are definitely going to be H100, the MI300X, just because the MI300X definitely has a better supply than Intel's Gaudi 2. Now we're gonna have to definitely see Intel Gaudi 3, but we don't expect that probably till the second half of this year. Now the stock, if we take a closer look at PE ratio forward, it's sitting at 23. PE ratio forward 1 year, which is the next 24 months, is sitting at 16. I want to say Intel does not look that bad when you look at these valuations. I do believe Intel's being a little bit conservative. It does seem like they're moving in the right direction. This is definitely not a stock I own, and I'm still not sure if I want to add on to it. But if you are an Intel bull, or if you're looking for, I don't think, I mean, obviously not advice, but I definitely don't see this as being completely overvalued. Obviously, there is a lot of risk here for Intel. We've kind of talked about that, the amount of cash flow they're using for their foundry business. Obviously, their AI solutions are not coming out or ramping up fast enough. And obviously, they need to take back market share from a very competitive pressure in both the client and the server CPU. Outside of that, though, right, there is that risk, but obviously that growth opportunities in all those segments as well. So definitely could see value in this to some extent. So let me know in the thoughts below. Are you buying Intel right now? Take care, have a good day, and make sure to hit that thumbs up and subscribe button.